Greetings to all our IMAPS clients and investors. Let me walk you through the latest changes made during the first week of October. The third quarter has been a tale of two cities: politics, geopolitics, trade relations, strategic alliances, immigration, central bank independence, and for argument's sake, anything that could be considered influential to economic activity has been subject to revision, debate, and/or change. Ex ante, a tsunami of such magnitude should have created massive economic waves hitting global stock markets hard. Paradoxically, global economic activity around the world blazed through the storm, displaying resilience and adaptability. Bullish equity markets across the globe were driven by earnings growth and multiple expansion, the former led by the US, while the latter was commanded by China. US AI revolution continues to propel growth, where American large language models account for 99% of the global market share. Furthermore, according to JP Morgan, 90% of capital expenditure growth over the last 2.5 years was attributable to AI-related investments. At the same time, China has become the frontrunner in global robotics, a superior positioning which is anchored by the nation's modern electrical grid and unique access to rare earth elements. A cohort of investors is becoming concerned about the risk of a market bubble. However, not all sectors and companies can be treated the same way. Hyperscalers, for example, continue to heavily invest in AI infrastructure funded by operating cash flows instead of debt. However, young AI firms, new nuclear energy players, and new ventures funded through private markets, where information is scarcer and valuations have skyrocketed over short periods, are areas on which we remain cautious. A persistent macro theme is the increasingly fragmented geopolitical world. President Trump's attempt to reach a ceasefire between Russia and Ukraine was not only unsuccessful, but also followed by Russian military escalation against Ukraine, along with a wave of Russian incursions into European airspace, an act capable of turning the conflict into a regional one if NATO shoots down Russian warplanes. The Middle East has not fared any better, where the horrific war in Gaza has already claimed thousands of lives and has made vast portions of Palestine uninhabitable. Meanwhile, 5 different Arab nations have been struck by Israel since hostilities began. The White House plan to end war following a meeting between Trump and Netanyahu brings a glimmer of hope to the situation. However, the deal's inner workings are still in early phases of negotiation. With all these developments in mind, what are the key factors to keep an eye on in the last quarter of the year? First, US labor market and monetary policy. A sharp increase in the unemployment rate could risk sending the economy into recession, triggering a market sell-off. The Fed's easing cycle and accompanying behavior will be key to establish how well the Fed is able to fulfill its dual mandate, as well as to remain and behave independently. Second, Eurozone challenges. European leaders are struggling to govern their countries, with the UK and France likely struggling the most to rein their budget, while once envied German manufacturing sector is now threatened by the end of cheap Russian energy, rising Chinese competition, and tariffs on US imports. On the bright side, Germany's prosperous service sector and low fiscal deficit provide a degree of flexibility, while buoyant European stock markets and companies are attracting global capital flows. Third, Chinese economic activity. Huawei's push to mitigate dependence on NVIDIA chips is a Chinese strategic necessity, in addition to the gateway to securing its global market share in the AI infrastructure race. Another important milestone is the successful trade agreement with the US to invigorate below-trend economic growth, where no short-term substitute exists for American consumption in an export-reliant Chinese economy. Last quarter was a busy quarter in terms of rebalancing and portfolio positioning to better capture macro themes. Following the thesis of a more fragmented and belligerent world, we have increased our exposure to defense. However, the allocation is with a bias to technology companies involved in defense activities as part of their product offering. In doing so, we seek not only to be better positioned to weather geopolitical risk, but to also be able to expand the exposure in the technology sector. Furthermore, the process of increasing financial deregulation in the US, together with a monetary easing cycle and healthy financial institutions' balance sheets, offer a good sectorial opportunity, which is why we have added to the allocation in US financials. Global diversification is another macro play which we have implemented by adding exposure to Japan and emerging markets, using specialized bottom-up managers to keep a surgical approach to markets where top-down passive allocation could be suboptimal versus active management. Finally, US large-cap growth is another sector where we have added exposure. While growth companies are the focus of the strategy, security selection is based on a value approach, where a sustainable industry competitive advantage is the main investment driver. We hope you are well, and as always, please reach out to your financial advisor or investment professional with any questions you may have. Thank you.